Did you know that the American stock market has been around for over 230 years and still creates millionaires every day? If you're interested in learning how to invest, generate passive income, and achieve financial freedom, this video is for you. We're going to cover everything from the basics to advanced strategies for growing your money. So go ahead and like, comment, and share to help more people reach wealth. Introduction to the stock market. Imagine being able to make your money work for you, even while you're sleeping. That's the power of the stock market. Many people still think investing in stocks is only for experts or the wealthy, but in reality, anyone can join in. The stock market offers unique growth opportunities for those seeking security and long-term prosperity. Today, we'll show you how to turn this idea into practical action, step by step. Investing in stocks also means becoming a part owner of companies that shape our everyday lives. From tech brands we use at work to the food giants that fill our plates. You get to share in their profits, challenges, and victories. And over time, every penny you invest can grow thanks to the power of compound interest. That's why, despite its ups and downs, the stock market remains the most direct path to building wealth over your lifetime. Why invest in stocks? The stock market isn't just a way to make money. It's a proven engine for building wealth. The New York Stock Exchange, founded in 1792, has been a pillar of global economic growth. Just look at the Dow Jones Index, which jumped from 120 points in 1925 to over 42,000 points in 2025. This means that by investing in stocks, you're becoming a partner in global growth. Studies show that over the past 100 years, the average annual stock return has been 10.49%, far outperforming any traditional savings account. Beyond the impressive numbers, investing in stocks lets you track the evolution of companies and industries that move the world forward. For instance, imagine if you'd invested in tech companies back in the early 2000s. Today, your wealth would have multiplied several times. This proves that stocks reflect not just financial data, but also the trends and innovations shaping society. And this link between money and transformation makes the market much more exciting than any other investment. This growth doesn't come without challenges. Economic crises, like in 2008 or during the 2020 pandemic, have brought markets down temporarily. But every time a market falls, it eventually recovers, reinforcing that investing in stocks is about investing in the future. After all, major companies keep growing, creating jobs, and adapting to change. The market rewards those who have patience and a long-term vision. Even if it seems risky, history shows that stocks are the highest return asset over time. How the stock market works. But how do companies get listed on the stock exchange in the first place? It all starts with an IPO or initial public offering, where companies open their capital to raise funds and expand their business. It's like opening the doors for investors to buy pieces of a company's future. Picture a fictional company called Dusk Guac that wants to grow fast. It splits its value into thousands of shares and sells them to investors. Each share represents a piece of that company's success and growth. Only companies listed on stock exchanges like NASDAQ or the NYSE have shares available for purchase. Private companies like Chick-fil-A don't have shares open to public. They're exclusive to owners and early investors. This means that when you buy shares, you're buying a real piece of giant companies like Apple, Coca-Cola, or McDonald's, and you get a small voice, however tiny, in their success. That's what makes the stock market so fascinating and powerful. It's also important to understand that stock exchanges work like huge trading hubs. Buy and sell orders are processed in real time, creating a dynamic environment full of opportunities. That's why the stock market is always moving, reacting to news, economic data, and even people's emotions. This constant motion is what makes stock prices rise and fall, creating chances for alert investors. How to buy stocks. Now let's get practical and learn how to actually buy stocks. The first step is to choose a reliable brokerage that will handle your transactions and keep your investment safe. Always look for brokers with low fees and a good reputation, like Robinhood, E-Trade, Schwab, or M1 Finance. These platforms are easy to use and offer tools for both beginners and experienced investors. Also think about the type of account you'll open. Standard accounts are great for getting started, while accounts like IRAs are ideal for retirement. Beyond choosing the right broker, it's essential to understand how buy and sell orders work. You can use market orders, which execute immediately at the current price, or limit orders, which only execute when the stock hits the price you set. Knowing the difference can help you save money and invest more strategically. Another crucial point is digital security. Enable two-factor authentication and never share your passwords. One more thing, know when the stock market is open for trading. In the U.S., trading hours are from 9:30 a.m. to 4 p.m. New York time, Monday through Friday. During these hours, the market is full of opportunity for those who know what they're looking for. If you live outside the U.S., many brokers offer global access. Just make sure you follow your country's regulations. So, there's no excuse not to start investing today. The first step is always the most important. How to make money with stocks. Making money with stocks isn't just luck. It's about understanding how the game works. The first way to profit is through appreciation. When the stock price goes up, you make money by selling at a higher price. For example, if you buy McDonald's shares at $290 and they rise to $295, that difference goes straight to your pocket. But there's another powerful way to earn: dividends. Companies like McDonald's share part of their profits with shareholders. In 2024, for example, it paid around $7 per share in dividends. Dividends are like passive income. You earn money without selling your shares. This is great for people looking for stability and who want their money to work on its own. Big companies usually pay dividends regularly as a way to reward investors who believe in their business. And the more shares you have, the more dividends you receive. This creates a virtuous cycle of growth. Your dividends buy more shares, and those shares earn even more dividends. Another interesting point is that companies with good dividends are generally stable and have consistent profits. This brings more security to your portfolio and helps cushion sudden market swings. So don't underestimate the power of dividends. They can become the foundation for a comfortable retirement and a more balanced financial life. What moves stock prices? Many people think stock prices are like a game of chance, but that's not true. Stock prices are determined by the old law of supply and demand. When more people want to buy, the price goes up. When more people want to sell, the price drops. But why do people decide to buy or sell? That's where market-moving factors come in. The first factor is inflation. When there's more money in circulation, people look to stocks to protect their buying power. Then there's company growth. Rising profits attract investors and increase demand for shares. Finally, there's investor sentiment. Fear and greed can be more powerful than any number or financial report. Just look at what happened with AI stocks. People bought in because they were excited, not just because of company earnings. On top of that, macroeconomic factors like interest rates and unemployment also influence the market. When rates are low, investing in stocks becomes even more attractive. Political or tech news can also sway investor moods. All these things make the stock market a living, constantly changing organism. Investment strategies. There are two main ways to invest in stocks: passive and active investing. With passive investing, you buy funds that track market indexes, like SPY, which mirrors the S&P 500. Index funds like VFX are also great because they have very low fees, around 0.04% per year, and provide automatic diversification. You just invest and let time do its magic. This model is perfect if you want a simple way to invest and take advantage of the market's long-term strength. ETFs are even more flexible and trade like individual stocks. They have fees ranging from 0.04% to 1.09% per year and can be bought and sold throughout the day. Plus, there are no minimum investment requirements, so you can even buy ETF fractions if you want. Index funds, on the other hand, trade only once a day, usually at market close, and typically require a minimum investment of about $3,000 to get started. That's why ETFs are more accessible for beginners and those who want flexibility. Let's not forget about mutual funds, which are still popular among traditional investors. They have average fees of 1.09% per year and require at least $2,500 to start. Unlike ETFs, mutual funds are actively managed by professionals who choose where to invest your money. This management can help reduce risks, but also means higher costs and less flexibility. Knowing the differences between these products is crucial for deciding where to put your money and balancing risk and return. How to analyze individual stocks. 1. Pick your own stocks. Then you need to learn how to analyze companies like a true investor. The first indicator you should know is market cap, which shows a company's total market value. For example, McDonald's is worth around $220 billion, while Coca-Cola is about $10 billion. This helps you understand the size of a company and its influence in the market. Bigger companies are generally more stable, but smaller ones can grow faster. Another key metric is the P/E ratio, the price-to-earnings ratio. This number shows how much investors are willing to pay for every $1 of a company's earnings. Right now, McDonald's has a P/E ratio of 27x, while Coca-Cola's is 17x. This means McDonald's shares are more expensive in relative terms. But remember, these numbers are just starting points. It's important to understand the context and what makes a company more valuable to investors. It's also a good idea to look at other indicators like revenue growth, profit margins, and debt levels. Companies that grow steadily have healthy margins, and low debt are usually more resilient during tough times. But don't just look at the numbers. Read annual reports, learn about the company's culture, and keep up with news in the sector. That makes all the difference. At the end of the day, investing in stocks is about investing in people, ideas, and innovation, and it has to make sense to you. Common mistakes to avoid. Even with all this knowledge, many beginners still fall into traps that can cost them dearly. The first mistake is trying to time the market, guessing the perfect moment to buy or sell. This is impossible to predict and almost always leads to losses. Another common mistake is panic selling when the market drops. If you sell at a low point, you turn a temporary dip into a real, permanent loss. Learning to control your emotions is as important as knowing how to read a financial report. Ignoring fees can also be dangerous. A 1% annual fee might sound small, but over 30 years, it can eat up to 25% of your total wealth. It's like a slow leak draining your gains bit by bit. Another mistake is the infamous YOLO, putting all your money into a single stock. That's like gambling in a casino, and it's not a long-term investment strategy. Diversification is key to reducing risk and protecting your financial future. Finally, there's inconsistency. Investing regularly, month after month, is what makes the magic of compounding happen. Many give up because they want quick results, but investing is like planting. You plant today and reap in the future. Having a plan, reviewing your goals from time to time, and sticking to the process are what separate amateurs from successful investors. Mistakes happen, but learning from them is what truly leads to growth. Today you've learned that investing in stocks isn't a mystery. It's one of the most powerful ways to build wealth. Remember to start with a trustworthy broker, define your investor profile, and stay disciplined. Market swings and crises are unavoidable, but patience and long-term focus are the keys to success. If this video helped you, like, share, and comment. Let's work together to change the way you see money. And remember, your financial freedom journey starts now. Click the link in the video description to unlock the ebook packed with investing secrets, mindset shifts, and wealth-building strategies.